Hello everyone. Welcome to a special edition of the Weekend Charts. I'm your host, Charlie Bilello. Today I want to talk about one of my favorite topics. This is something I do every year. It's called Put These Charts on Your Wall, and this is the 2024 edition. So without further ado, let's begin. Put these charts on your wall for the next time you think all-time highs are a sell signal. This is something you're going to hear a lot, and we certainly heard it in 2024 again and again, and that's because we've hit 57 all-time highs in the S&P 500 so far this year, on pace for the fifth most in history. And what you often hear is that saying, buy low, sell high. So when you hit an all-time high, you naturally have this tendency, and you have these people saying, well, that's a good time to sell. The only problem is, well, the market tends to go up over time historically. Earnings tend to go up over time historically. So all-time highs by themselves are not anything unusual. And we can see, just looking at the data, what tends to follow all-time highs. Well, it's more all-time highs. 1 year later, the S&P 500 on average is up over 10%. Not much different than a day where the S&P isn't at an all-time high. And importantly, the longer you go out, the higher the expected return for investors. So if you're holding for 5 years and 10 years, you really shouldn't care whether the market is at an all-time high or not. Your odds of a positive return are going to be way higher than if you're just holding for a day, a week, or a month. So all-time highs by themselves don't tell you anything about what the market's going to do going forward. Investment returns are linear. It would be nice if they were, if we got that 10% historical return each and every year, but that's not the way it works. Returns are lumpy to the upside and the downside. 1 every 4 years is negative for the S&P 500 historically. So you could see the left side of this chart, all down years for the S&P 500. And when the market's up, it's not up always this 10%. Sometimes you'll have a 10% return, but more often than not, it'll be up either more than that or less than that. And this year, another year, 2 in a row, in fact, where we're in that 20 to 30% range. So more than double the historical average so far for 2024. So just remember that you're not going to get that 10% each and every year. That's going to be a long-term average if you're a long-term holder for the stock market. Hopefully that will be what it is going forward. That's what it's been over the last 100 years, but it certainly hasn't come in a straight line. Okay, it's oversold, it's overbought, and it can't possibly go any lower or higher. You can hear this each and every day looking at different stocks. You'll say it's gone down too much or it's gone up too much, and shouldn't it pull back a little bit? It's either oversold or overbought, and you hear these technical terms. I'm just going to give you 2 examples here of the way markets actually work. They don't respect these terms, oversold and overbought. When the downtrend is very strong, it'll continue to go lower. Virgin Galactic being one of the best examples in 2024. You can see very early in the year, it starts going down. It's oversold, but it continues to go lower. Oversold many times, lower and lower and lower. And you can see where we are, $6 per share. We started the year above $40 a share. So huge decline. Markets don't have to bounce from oversold levels. They can continue to go lower, especially individual stocks. And on the upside, we're looking at Palantir here, one of the strongest performers in the markets this year. Overbought very early in the year, and you can see many other times this year. And if you just saw it at $20, it's an overbought. Well, now it's 4 times higher at over $80. So you have these strong trends in markets that don't respect overbought, oversold, and they don't respect support and resistance because the trends are much stronger than these technical concepts. So kind of throw that out the window in markets in terms of looking for mean reversion. When you have a strong trend, it can persist in either direction. Okay, let's talk about credit card rates. This is not a fun one for anyone who has credit card debt, but you hear this all the time. Credit card rates can't go any higher. We've been hearing that in recent years because we've seen record high after record high. And once again, in 2024, we're seeing another record high for credit card interest rates in the US, 21.76%. And just a few years ago, in 2022, you had rates at 14.56%. So significantly higher. And you can apply this to many things where they say it can't possibly go any higher. And I'm just giving you the example of credit card rates here. Now let's talk about credit spreads. And a number of times this year, I heard people say, well, they can't get any tighter. Credit spreads are just looking at the yields on corporate bonds, so whether investment grade bonds or high yield or junk bonds, and taking that yield and looking at the difference between that yield and a treasury bond yield of similar duration. And this year, we saw the tightest investment grade spreads since 1998, 0.77%, and high yield spreads, really remarkable here, 2.6%, tightest since June 2007. So just when you think it can't get any tighter, it actually continues, and we're seeing spreads here. It's been a long time since spreads have been this tight. Can they get tighter from here? Of course they can. It's been there before. It could do it again, but very, very low, historically low levels. Only a few times in history we've seen lower than this. But again, there's no lower bound. There's no upper bound. Markets are constantly doing things that they've never done before. Stocks can't go up when the Fed is shrinking its balance sheet. You heard this a lot when the Fed started their quantitative tightening. They started letting securities roll off their balance sheets. And I just want to highlight what's happened over the past 2 years. Obviously been a very strong equity market. You have the S&P 500 over the last 2 years up 57+% on a total return basis. And the Fed over this period of time has actually shrunk their balance sheet by nearly 20%. So this notion that you need quantitative easing for the markets to go up, clearly not true. If you look historically, yes, when the markets are ripping and there's quantitative easing, is that helping maybe psychology? Perhaps, but it doesn't mean that the S&P 500 needs quantitative easing. Clearly, over the past 2 years, we've seen that it definitely doesn't to go higher. And so what I like to say was one of my rules for markets is fight the Fed. This notion that you should be following the Fed's every move and only investing when the Fed is easing monetary policy and when they're doing quantitative easing. If you look historically, that absolutely hasn't been the case. So if anything, ignore what the Fed is doing, stick to your long-term game plan. Okay, an inverted yield curve is bearish for stocks. This is something you hear a lot. Inverted yield curve, as we've talked about, tends to be a leading indicator of recessions in the US. And so people take that when they say, well, that must be bad for the stock market. The problem is the stock market is not the economy. And a yield curve is a long leading indicator. When it inverts, it could take a few years before a recession begins. And what we saw actually since October 2022 was the longest inversion in history for the U.S. yield curve, looking at the spread between the 10-year Treasury yield and the 3-month Treasury yields. We went over 2 years with this thing being negative, meaning the 3-month Treasury bill was above the 10-year Treasury bond yield. And that's very unusual. We've never seen it this long in history. And now it's back in positive territory. So what I'm showing you here is what's transpired during that period of inversion here. We've actually seen the S&P 500 gain 62%. So certainly not a timing mechanism for the stock market. You certainly would not have wanted to miss out on 62% gains because you were worried about that inverted yield curve. Mortgage rates must go down when the Fed cuts rates. So the Fed has been cutting interest rates since September. They've actually cut now 100 basis points in total so far. And we've seen this interesting thing go on where mortgage rates are not going down. They're actually gone up over 1 percentage point since the Fed started cutting rates in September. So they were at 6.11%. Now they're at 7.14%. So over a percentage point increase in the 30-year fixed mortgage rate. And the reason for that is that mortgage rates aren't tied directly to short-term interest rates like the Fed funds rate. So when the Fed is cutting interest rates, they're cutting short-term rates, but mortgage rates are longer-term securities, mortgage bonds, and they're more tied to the 10-year and the 30-year Treasury yields, and those yields have gone up since the Fed started cutting interest rates, and they've got up because inflation expectations have gone up. So who knows where mortgage rates are going next year, but just because the Fed is cutting interest rates doesn't mean necessarily that these longer-term rates like mortgages are going to have to come down. So just an important thing for people to remember. The Fed is controlling short-term rates, which is going to determine your savings rates or your treasury bill yields, but it's not going to determine longer term rates for things like mortgages. Okay, the housing market can't get any more unaffordable. And you would think that there would be a limit to this. Obviously, there is at some point, but we haven't seemed to hit it so far. And I'm showing you here an affordability gap that is just enormous, almost 50% gap between the income you need to buy a house, which is about between 110 and 120,000, and the actual income, the median household income in the US is still under 80,000. So there's a 49% differential between the two, which basically means that for most people, the average house is unaffordable. And we've just seen this based on two things. Number one, the mortgage rates in the US have gone from below 3% to about 7%. And number two, we've seen a price appreciation that we haven't really seen since the housing bubble in the early 2000s, with an enormous increase in prices. So you have that double whammy of higher prices and higher mortgage rates causing this big affordability gap. So needless to say, for the average person, housing market very much unaffordable at current prices. So you either need mortgage rates to come down or prices to come down for this gap to narrow. Okay, vacancy rates can't go any higher. And here I'm talking about office vacancy rates, which hit a record high in 2024. They moved above 20%. This is data we have going back to 1979 in terms of office vacancy rates. And obviously, most people know the reasons for this. There was a big office market boom in terms of building. So you had a lot of supply out there. And then you had, since COVID, this transition to working from home more. And really, despite people going back to the office more, that hasn't completely come back. So you have this vacancy rates rising and rising as companies adjust to a hybrid work schedule where people are working from home and from the office, so they don't need as much space. So just seeing continued increase in vacancies so far this year. Hard to believe it can go much higher, but again, there's no hard limits in markets. It certainly can go even higher in the short run. Okay, you can trust all government data on inflation. And I'm not saying here that everything the government puts out in terms of inflation is wrong, but here's just one example of something that's clearly wrong, and they haven't changed the methodology for this. It's looking at U.S. health insurance prices, so the premiums that you pay. And what they're saying here, based on their way they interpret this, is that health insurance rates have actually gone down 26% over the last 2 years and 13% over the last 5 years. And of course, anyone who's paying for health insurance knows that it really only goes in one direction, and that direction is up. As I'm showing you here, the increases since 1999 in average family health insurance premiums, 342%, which is way above the inflation increase, the overall increase in CPI, 86%. So don't trust everything the government is putting out in terms of inflation. Do your own reality check, and my reality check is saying there's no way that prices for health insurance have gone down 13% over the last 5 years. Emerging markets can't possibly underperform any longer. It seemed like this has been going on for years, and that's because it has been going on for years. The U.S. has been outperforming and emerging markets underperforming for 13 years now, so since 2011, and we actually hit a record low in this ratio of emerging markets to U.S. stocks, surpassing the low from March 1999. That was the prior low. We have emerging market data going back to the late 1980s, record low in terms of the spread. You could see historically you have cycles of EM outperformance and underperformance, and this is the longest cycle of underperformance for emerging markets that we've seen, and it's at a record low. So the question would be, can it continue to go lower? And of course, the answer is yes, it could. There's no bottom limit. There's no upper limit. So speaking of the upper limit, let's look at the flip side of this. US stocks can't possibly outperform any longer. So this is US versus all global equities. So not just emerging markets, but everything else, all other developed markets in Europe and Asia, everything MSCI World, excluding the US. So that ratio of the S&P 500 to that is at a record high, more than 3 standard deviations above the mean. And we've now seen the US outperforming in terms of this cycle for 16 years running, which is the longest period of outperformance we've seen in history. Question again, can it continue to go up? Is there an upper limit? And of course, we know the answer is no. That doesn't mean it will, but you just can't say that it necessarily has to stop here. Another way of looking at this is looking at the equity weightings by country. And the US over this period of time has gone from about half of the market cap of the globe to now 65%, which is a record high. So 65% of this FTSE Global All Cap Index is now US stocks, which is more than 11 times higher than the second largest component here, which is Japan at 5.5%. Now, can this go to 70%? Of course it could. There's no upper limit in markets. You can't say that this outperformance has to stop here and now. Okay, markets follow a normal distribution. Every year there's examples of fat tails in markets, and the biggest one that we saw in 2024 was the Nikkei crash, where over 2 days, Nikkei's down 17.5%. It was culminated on August 5th, 2024, Black Monday for the Nikkei market. So Japanese stocks down 17.5% over the Friday and Monday period. That was bigger than the decline we saw in the October 1987 crash. And if you look at this in terms of probabilities, the probability of this happening if markets followed a normal distribution is less than 0. It never should have happened in the history of the universe. This is a 10 standard deviation event for the Nikkei index based on its historical data. So really never should have happened if it's a normal distribution, but it doesn't follow a normal distribution, which means that these fat tail events happen much more frequently than you could predict if it did follow a normal distribution. You're going to see these outsized returns on the upside and the downside each and every year. The names change, but the story remains the same. Markets are not linear. They don't follow a normal distribution. You have these fat tail events that seem to occur much more frequently than a normal distribution would predict. So it's only a matter of time before this happens again, whether it's in the Nikkei or something else. 2025, no one knows where it's going to be, but we're going to see this fat tail event pop up somewhere. They'll never balance the budget. I think people would have said that about Argentina for a long time. It's been a very long time since they balanced the budget. Javier Milei takes over a year ago, is elected president of Argentina, and you had a deficit of 5% of GDP. And by the first quarter of his administration, they actually have a surplus for the first time in a long, long time. And what I'm showing you here is the Argentina monthly inflation rate, which I think people would have said was impossible to bring this down. It was 25.5% last December, and we look where it is today, 2.4%. And the expectation is if they continue to operate this way, this inflation rate will continue to come down, and the budget will continue to be not only balanced, but actually have a surplus. The biggest companies can't get any bigger. This was a pretty good argument to make coming into the year because we were already at record highs for the Magnificent Seven type of stocks that we've talked about a lot after 2023, but these companies have only gotten bigger in 2024. And looking as a percent of the S&P 500, we entered the year at a record high in terms of the top 10 holdings in the S&P 500, making up about 31% of the index, and now we're at 37.6%, so far surpassing the prior record. You can see here this is data going back to 1980, and if we look at the top 3 stocks, so Apple, Microsoft, Nvidia, currently as a percentage of the S&P 500, over 20%, the highest we've seen, again, with data going back to 1980. And looking at large caps versus small caps, a few months ago, we actually saw the ratio of large caps to small caps hit its highest level since October 1999. So a very long period of large cap outperformance versus small caps. And over that period of time, we've seen increasing concentration, record concentration in the S&P 500 index. Cars are appreciating assets. Probably sounds ridiculous, but it was only a few years ago. You go to the middle of 2022, you're seeing a number of articles like this. EV demand is so hot that Tesla's owners are flipping their cars like houses. So people were saying, looking at this period here, I could buy this Tesla at 50,000, sell it for 60,000 or more, make a quick profit. The prices were going up for a long period here. And now we've seen the flip side where reality has set in. Obviously, as the car gets older and its value should go down, you're going to need to replace different parts. It shouldn't continue to go up unless you have this crazy hyperinflationary environment. And what we've seen is the average price of a used Tesla actually go down well over 50% since the peak in June 2022, which is to say that cars are not appreciating assets. They depreciate over time unless it's some type of collectible that's in very short supply. Speaking of collectibles, a lot of people collect watches. Rolex watches are among the most popular. And you'll hear things like this, like they always go up in value. And people were saying that a few years ago, which should have raised a red flag. We saw this huge surge higher. Looking at this index is a secondary market index of Rolex watches, 30 different models. And you could see just the explosion that higher that we saw in 2021 and into the peak in early 2022. And since then, what we've seen is a pullback here, 31%. And I just want to illustrate this because nothing only goes up. There's no such thing as a volatile asset class that only goes in one direction, is up. So where are these watches going from here? I have no idea, but this is a good chart to have in your world to suggest that there's nothing, no collectible or anything else that only goes in one direction up. Everything has drawdowns, everything has pullbacks, unless you're looking at something like a treasury bill where you're simply parking your money in short-term instruments where you're guaranteed by the government to get your money back. Rolex watches not the same as a treasury bill, so this should not be unusual. They're only worth what someone's willing to pay for it, and obviously what people have been willing to pay for it is now 31% lower than it was a few years ago. Okay, past performance is indicative of future results. Now, of course, we know it's not, but people often use the past or recent performance to suggest that that's going to continue in the future. And this was a stock, Moderna, that was absolutely on fire. Obviously, one of the big COVID vaccines and benefited from that trend in 2020 and 2021. And if we look at the 3-year return from 2018 to 2021, enormous outperformance, 1,680% versus a 95% gain for the S&P 500. So if you looked at that period and you said, well, this is indicative of what it's going to do going forward, you would have been highly upset today to learn that 3 years after this, Moderna is down 85% over the last 3 years, while the S&P 500, as we talked about earlier, is still hitting all-time highs, up 33%. So past performance, definitely not indicative of future results. Picking stocks is easy. Just buy what you know. This is a concept, kind of the Peter Lynch concept, where people try to make it much simpler than it actually is in reality. And so what people know are companies and products that they use. And just about everyone has bought a Nike sneaker probably at some point in their lifetime. And they know it. They're comfortable with it. And for a long time, Nike stock did very well. And then you have this situation where it doesn't do well. In the last 5 years, Nike stock is down over 18%, while the S&P 500 is up 99%. So just simply buying what you know, yes, sometimes it might work and it might work very well, but nothing is that easy. Nike being the latest example of you can buy something that you know very well and it could still not keep pace with the market and in fact go down when the market has nearly doubled, which is what's happened in the last 5 years. A valuation can't go any higher. So you often say, this valuation is stretched. I can't see it going any higher from here. And the biggest stock in the world, Apple, people were saying that all year. I've been highlighting it many times, and it continues to just push higher. This is its price to sales ratio, now trading at over 10 times sales. Incredible for a company its size. You're talking about a company well over 3 trillion, again, biggest company in the world, not growing nearly as fast as it was back when the iPhone came out in 2007. But you're talking about a multiple here, highest in history for Apple. Does it have to stop at 10? No, the point is we don't know how high is high when it comes to valuations, and Apple being the latest example of this. A high valuation is a sufficient reason to short a stock. You really only learn this the hard way, and I think the hardest lesson was anyone trying to short a stock like Palantir based on a valuation. In January, it probably seemed appealing. You had a P/E ratio of 190 for Palantir and price to sales ratio of 18 times. So we just showed Apple at 10. This was trading at 18 times sales and 190 times earnings. And look what's gone on since then. Well, now it trades at over 400 times earnings and 73 times sales. And you can see the stock is up 369% a year to date. So just shorting based on valuation and valuation alone can be a very dangerous game to play. Investors are rational, and there's probably 100 different charts I could pull here, but my belief very much is investors are definitely not rational. We've seen irrational behavior time and time again, and I can't think of anything more irrational than speculating on something called Fartcoin. I can't believe I'm even talking about it, but I have to mention here because a few days ago, Fartcoin's total market value went over 1 billion. This is a meme coin that was created really as a joke, and all of a sudden its value is over $1 billion. And as I highlighted in this post on X here, 1.25 billion market cap is bigger than 847 companies in the Russell 3000 index. So these are real companies where Fartcoin has a value above it. Is that rational? Does that make sense? Do people buying and speculating on this, are they appreciating any of this? Absolutely not. They're irrational. They're just buying it on the greater fool theory that someone will come along and buy it at a higher price. Is this going to end well for people investing? I can't even use the word investing, for speculating on something like Fartcoin. Probably not. Almost certainly we're going to see this thing crash in 2025. So I will highlight this a year from now on the charts on the wall as likely an example of something that simply shows the irrationality of investors and this idea of HODL, hold on for dear life, that people are buying these things and they're going to hold them forever. I don't think it applies to something like Fartcoin. I think as soon as it starts going down, you're going to see anyone with profits in this thing bail out at the first sign of weakness, which would be rational in my view. Okay, this streak can't go on any longer. You often see various streaks in markets that seem like they're too long, they're hitting records. How can it continue to go on? I want to highlight the Dow and all-time highs. So we showed the S&P 500 earlier, but the Dow has now hit all-time highs for 12 consecutive years. So every year from 2013 through 2024, it's hit at least one all-time high. And there's only one other period in history that matches this. That would be the period from 1989 until the peak in 2000. That was the peak of the markets, where of course then there was a big drought of years without any all-time highs. But the point is to say, does this streak have to end here and now? 2025, are we saying now it can't hit an all-time high? Certainly not. I think, as we showed earlier, the base case expectation is probably we get at least one in 2025, but we'll see. The point is nobody knows. So you can go years without an all-time high, consecutive years, many years in a row, and then you can go like we are today with 12, and maybe in 2025 we hit a new record of 13. So the market's constantly doing things and having streaks that it's never done before. Profits don't matter anymore. This is something that you only hear during the height of manias, and we heard this a lot back in 2020, 2021 during the meme stock mania and the SPAC mania and everything. It was really an everything mania back in 2021, 2020, 2021. And Nikola was this EV company with really no revenues, just losses, and there was a big mania in its stock price for a little while, and then it was revealed they were doing a lot of different shady things. And you could see what's happened since then. But the interesting thing to me is that it's lasted for this long. It still hasn't gone bankrupt. I think that's likely to be coming, just looking at the cumulative losses here building up, but never made a dime in profits. This thing is now down 99.9%. So back in 2020, where people saying profits don't matter anymore, they didn't matter in that moment, but ultimately the weighing machine sets in, and investors will say, well, now it matters. And it matters very much when you have no more cash on your balance sheet and you're incurring these huge losses. Well, then it matters very much. And that's absolutely what's going on here. Year to date, you're seeing just it plummeting here. I'm guessing they're either weeks or months away from running out of cash and having to file for bankruptcy. It can't go to zero. So it seems unlikely for many stocks to go to zero. But every year, obviously, there's bankruptcies. And the interesting thing is just going back in time and saying, would you have predicted this a few years ago? And in many cases, you absolutely wouldn't. Something like Tupperware, you say, well, that seems like a safe, relatively stable business. And a decade ago, 11 years ago, it's hitting record highs. It's doing very well at that point in time, back in December 2013. And here we are this year actually filing for bankruptcy. So any individual stock, this is a lesson for investors, why you have to be diversified. Any individual stock can go to zero. So be very careful and concentrating in any particular stock. And just because it's gone down doesn't mean it can't go down even more. Bonds are risk-free, and I've been attacking this notion for years, but here's yet another example. We're at the longest bond bear market, so the longest drawdown for the bond market in the US in history, 52 months and counting. I say and counting because we're still well off the all-time highs that we hit in 2020. You can see that nothing compares to this. The previous longest bear market in history was 16 months back in the early 1980s, and now we're at 52 months and counting. So bonds definitely very much have risk, and you can go years, as we've done over 4 years now already, where bonds have not hit a new high in terms of their total value, including the interest and dividends. And that's because we had the lowest interest rates in history back at the peak in 2020, and interest rates now are much higher, over 4% higher for looking at something like the 10-year Treasury year. So bonds, be aware of what you own and why you own it. It's not risk-free. Yes, does it have lower volatility than the equity market? Yes, but you can have this situation when you have extremely low yields like we have in 2020, where you can go years without hitting a new high in the bond market. Buying a stock based on a meme is a good idea and seemed like a great idea back during the meme stock mania in early 2021. But you fast forward to today, and most of these meme stocks are down 90% or more. I'm just highlighting one of the more popular ones here, AMC, down 99% from its peak in June 2021 to today. Correlations are static. This is important because most of you who are watching this have different asset classes in your portfolio, and you can calculate a correlation among those asset classes. So how likely are stocks and bonds likely to move together, or stocks and real estate, or bonds and real estate, or commodities and currencies, different things. Correlations, though, are not static. There's not a set correlation that you're going to get, for example, between the stock and the bond market. And what I'm showing you here is just looking at the S&P 500 and Bloomberg Ag U.S. bond market over time, a rolling 3-year correlation. And right now, as we speak, the last 3 years, we've seen a higher correlation than we've ever seen, which simply means the stock market and the bond market are moving together like never before. But, and here's the big but, going forward, the next 3 years, is this telling us that correlations are going to stay high? Is it going to telling us anything? No, absolutely not. The next 3 years, we could see a correlation of zero. It could be negative, or it could stay high. Correlations are not static, and they're not predictable in advance. So we don't know going forward whether the stock and bond market to continue to move together in the future. The reason why they've moved together so much over the past 3 years is because inflation has been the primary concern. And when the inflation is high and there's a correction, well, now you have a situation where both the bond market and the stock market are selling off on a similar concern, and that being high inflation, high interest rates, which hurts the stock market and the bond market. So if you think inflation is coming down, it's going to stay down, not be as big of an issue over the next 3 years, we're likely to see this correlation move lower. But just be very careful in assuming that correlations are static and that what we've seen in the past in terms of correlations is necessarily going to be true in the future. Making changes to your portfolio based on headlines is a good idea. You know, if you've been watching me for any period of time, I hate headlines that make statements that aren't true. I hate the idea that there's investors out there that are looking at these headlines and actually following it as advice. And this was one of the worst headlines I've ever seen. It was saying a year ago that presidential election years are bad for stocks. And it made the case in various things. I don't know what data they were looking at because there was no evidence historically of this. Actually, election years, presidential election years, show better than average returns for the U.S. stock market historically and a higher percentage of positive returns. And what have we seen so far this year? We've seen the S&P 500 up 26% on a total return basis, so certainly not a bad year for stocks, more than double the historical average, and there was no basis for this. So don't be following any of these headlines. And if you're going to look at a headline and get it creates an emotional reaction, well, go and dig up the data, and you'll most likely find that the hyperbole that they're using in the headline isn't actually true if you dig into the data. Rising national debt must be bad for the stock market, and I'm concerned about the national debt. I don't want to see it continue to explode higher. I want to see the deficit cut. You know, I've talked about this many times, but there's a difference between the stock market and what the federal government is doing. We could see here milestone after milestone. So this year hitting 36 trillion for the first time, and I'm sure that we're likely to hit more of these milestones in 2025. Now, as an equity market investor, has it been a good idea, though, to look at these trillion-dollar increases and not invest in the stock market? Absolutely not. If you look at the last 30 years, the U.S. national debt's up over 7x, while the S&P 500 is up 2,200%. And the reason for this is the stock market is going up over time because corporations are very different than the government. Corporations are actually trying to create a profit, so they're not running at a deficit like the government is, and their profits are going up over time. And that's most of what the long-term return that you're getting is the compounding gains in terms of earnings, 2,200% over the past 30 years. Doesn't mean that as a citizen, you shouldn't want to have a check on national debt, and you don't want it to certainly develop into a crisis, but the companies that you're investing in terms of the stock market are not behaving in any way, shape, or form as the government is behaving in terms of spending more than what they're taking in revenue. Big returns come without big drawdowns. I think when we see these things, these big winners over time, it's tempting to assume that they got there without any difficulty. And Apple, just look at the tremendous gains that it's had since its IPO in 1980. 257,000%, kind of a crazy number. You can't even fathom a number that big since 1980. And look at the reason why you've gotten that big return. It's because there was risk. Look at the drawdowns that Apple has produced over time. It definitely wasn't a straight line. You would have had to stomach 80% drawdowns more than once in Apple's lifetime, more than 50% during the financial crisis. And just look at the past few years, you're seeing a number of around 30% declines. And so looking at Apple today, the one thing we can say for sure, even if you think it's going to continue to go up from here, and have strong returns, we're likely to see more big drawdowns. There's no big upside without occasional big downside along the way. That's just the trade-off in terms of investing in markets. All the big winners have big drawdowns along the way. This has to be the top. And this is a feeling, it's a natural feeling to have when an asset class is going parabolic and it seems like it's hitting new highs every day. You're likely saying to yourself, well, this can't continue to go on. It has to be the top. And I think Bitcoin, more than anything else this year, would have been the asset class you were probably thinking about that. Early in the year, you had this tremendous run. It ended up hitting its first new all-time high since 2021. Then it kind of traded sideways to down for about 8 months until the election. And then you had just a surge back to a new high on election day and then the day after. And every day after that, you could have said to yourself, this has to be the top. This has to be the top. 74,000. Then it hits 80,000. It hits 90,000. And recently it hit 108,000. Is that the top? Nobody knows. There will be a top where there's a big drawdown or bear market that follows, but these things are impossible to predict. And Bitcoin, probably the best example of this that I could think of in 2024. The travel industry will never come back. You heard a lot of people say that back in 2020. Well, I'm happy to report not only has it come back, it's stronger than ever before. We had a record number of airline passengers this year traveling in the U.S. We hit a record high just recently, 3 million after the Thanksgiving holiday in the U.S. Flying in that particular day. And we're well above where we were pre-COVID in terms of average levels of flying. And if we look at these two stocks, I think it tells an important story for the travel industry. Delta Airlines and Royal Caribbean both not only hitting new all-time highs this year, but surpassing those prior highs and digging out of that enormous drawdown during the COVID crash in 2020. If you go, you can go back and pull up headlines, and a lot of people said it's going to be never that you're going to have these cruise ships filling up again. And here you have Royal Caribbean hitting all-time highs and doing better than ever before, and Delta very strong as well. So don't count out the American consumer ever. The travel industry is not only back, but it's hotter than it's ever been before. Central planning is a better system than free market capitalism. That seems like a crazy thing. Obviously, I don't believe it, but people were saying it for a long time for when China was outperforming the U.S. in terms of its stock market performance. And if we look at the last 10 years, a very different story here. That NASDAQ 100 ETF up 437%, S&P 500 ETF up 241%, and the China large cap ETF actually down over the last 10 years. I don't know what will happen in the next 10 years, but there's no comparison. Free market capitalism beats communism every single time. Central planning is not the way to go. And certainly if you look at the Chinese economy, look at Chinese corporations as an investor, in the long run, if they keep that model, your expected return should not be as high as places that have free markets like the U.S., where you're rewarded for the risks that you take. Entrepreneurs are rewarded, and you have this system of laws and governance in terms of accounting rules and everything else that we have in the U.S. So the last 10 years really obviously bear this out. Again, no idea what will happen going forward. Chinese stocks hopefully will do well because they start to become more like us in terms of giving their citizens more freedoms and allowing their markets and companies to be more free. Okay, Wall Street experts can predict the future. Obviously, they cannot. And if this chart looks familiar, it's because I've had it on put these charts on your wall for the last few years. And every time in the last few years, the average and every prediction has been off. And in 2023, everyone was under the target, and we're seeing that so far this year as well. 59.31 in the S&P 500, the highest target entering the year for the S&P 500, 5,400. So in 2024, S&P 500 above every target price at the beginning of the year. In 2023, S&P 500 above every target price at the beginning of the year. 2022, when we had that bear market where the S&P 500 is down 18%, You have every target above where the S&P 500 ended the year, and then 2021, another strong year for the stock market, and the S&P 500 ended that year above every single target. So big lesson for investors is don't invest based on these targets. It's impossible for anyone to predict the future, and this idea that there's an expert out there that could magically do it, absolutely not true. Putting money under your mattress is an effective strategy to combat inflation. And this is the last chart. It's the most important chart in terms of investing, because it's really why you need to invest in one chart. And the reason why you need to be an investor in the long run is that there's going to be inflation, and just putting money under your mattress, that means your purchasing power is going to be eroded. So I don't know what the inflation rate in the US is going to be over the next 30 years, but I can tell you it's going to be something. And the value of your dollar, the purchasing power of that dollar, is going to be less. So in the last 30 years, the purchasing power of your dollar has been more than cut in half due to inflation. And you're going to see a decline in that over the next 30 years as well. And historically, if we look in the last 100 years, the best protection against that inevitable decline in your purchasing power has been an investment, has been an owner, an investor in the stock market. S&P 500 total return adjusted for inflation over 1,000% in the last 30 years, over 8% per year. So certainly better than average. But even if we look at the last 100 years, S&P 500 over 6% above inflation. So be an owner, be an investor. And this one chart really tells you that story more than anything else. So they say a picture's worth 1,000 words, and when it comes to markets, that's absolutely true. Having a few extreme charts on your wall can be helpful to serve as a reminder that there's no such thing as can't, won't, has to, never, always when it comes to markets. The markets don't have to do anything, least of all what you think they should do. They're the real-time personification of collective human psychology, with fear and greed and all the other emotions on full display. And that's what makes it so hard, and at the same time so interesting, because there are times where skepticism is warranted, but other times where you have to suspend disbelief. But there's no manual to help you decipher which situation applies. So find some charts that speak to you personally. For everyone, that's different. Find those charts and put them on your wall as a constant reminder that the range of possible outcomes is much wider than any of us think, because there is no impossible in markets. Thanks everyone for watching this today. I want to wish you all Merry Christmas, Happy Hanukkah, Happy Holidays. If you're not already subscribed to the channel, hit that subscribe button for a lot more content like this in 2025. I'll see you next time on the Week in Charts.